Okay, dear students, let's start section A on throughput accounting. In the previous, I would say, 2 classes, in one class, we did discuss TOC, theory of constraint, and then throughput accounting. We have discussed all the concepts, all the theoretical area of throughput accounting. Now the time has come that we should be implementing the knowledge in section A, and after that, we'll go for section B. So let's start. Throughput accounting. When demand exceeds supply, so demand is more than the supply. Wow. Demand is more than the supply. So you should try to focus on increasing the supply. Which one of the following situations would increase the throughput accounting ratio? So which one of the following situations will increase the throughput accounting ratio? We know that how do we calculate throughput accounting ratio? That is, first we calculate throughput, then we divide that throughput with the bottleneck resources. First we calculate throughput per unit. So simply we take, let's say, selling price per unit. We minus direct material cost per unit. We get throughput per unit. Then it is divided by bottleneck resources which are required per unit. Then actually we get a return per factory hour. Then we get return per factory hour. We have seen one question where bottleneck resources, they were not in hours. We took them in minutes. So instead of return per factory hour, in that question, we use the term return per factory minute. But normally it is in hours, so return per factory hour. So once you have calculated the return per factory hour, then throughput accounting ratio is actually equal to return per factory hour divided by cost per factory hour. Cost per factory hour. Now, which cost? Basically, factory cost per hour. Factory cost per factory hour. What do you mean by factory cost? Simply, the factory cost is your operating expenses. Let's make it more easy. Factory cost is simply, you can say that, direct labor and production overheads. So you can say factory cost is simply your conversion cost. Direct labor cost plus production fixed production overheads. In the factory cost, we do not consider any, we're not going to consider any non-production cost. Let's say you have calculated factory cost, then factory cost will be divided by the factory hours. It could be, if your factory cost is per week, you will divide with the hours per week. If it is per month, then you will see what are the factory hours per month. You will get factory cost per factory hour. Okay. So how to improve the throughput accounting ratio? A says an increase in the speed of the fastest machine. Incorrect. Actually, when we are calculating throughput accounting ratio, so what do? We calculate first throughput per unit. Then this throughput is actually divided by the bottleneck resources. Bottleneck resource is your slowest process, is your slowest machine. It is not the fastest machine. Since we calculate actually return per factory hour. You can say we calculate throughput accounting ratio on the basis of bottleneck, and bottleneck is the machine, is the process which is the slowest, not the fastest. That is why statement number 1 is incorrect. An unexpected increase the factory rent. If your factory rent increases, means your fixed, let's say, production overhead increases. So actually, your throughput accounting ratio will not improve. It will further deteriorate. A 5% wage increase linked to an 8% improvement in the productivity. Great. If you're increasing the wage by 5% and productivity, there's an improvement in the productivity by 8%. So what happens? Obviously, due to increase in wages, your factory cost will increase, agreed. But there's an 8% improvement in the productivity. Now, you will be taking, your labor will take less time to manufacture the same product. And the improvement is 8%. So we can say that overall, there's going to be a benefit. Overall, the throughput will improve because the productivity is more than the increase in the wages. Productivity percentage is more than the increase in the wages. So since the productivity percentage is more than the increase in the wages, because we know that if we are going to start taking less time to produce the same unit, so obviously there's an increase in the productivity. Increase in the productivity means a return per factory hour will increase. So since increase in the productivity is more than the increase in wages, so yes, your throughput accounting ratio will improve. A 10% discount to stimulate demand? No. Illogical. Why illogical? Already what is happening? Try to understand, students. Already we are not able to meet the demand. Already demand is higher than supply. Already demand is higher than supply. Already the supply is less. Demand is more. If you decrease your selling price and you start giving discount, demand will increase more. So what benefit will you get? Already you are having demand more than your supply. So now there's no need to work on increase in further demand. So D is not suitable here. So 55, logically the answer is C. 56, what would be the effect on the following actions on the company's throughput accounting ratio? Place a tick in the appropriate boxes in the table below. Again, never forget how do we calculate throughput accounting ratio. We take selling price per unit minus direct material cost per unit. We get throughput per unit. Then logically, this throughput is divided by the bottleneck resources required per unit. Once you have divided this with the bottleneck resources required per unit, then you get return per factory hour. And return per factory hour is divided by factory cost per factory hour. Or you can say conversion cost per factory hour will give you throughput accounting ratio. So obviously when this is how we calculate throughput accounting ratio. Now come here. They are again talking about throughput accounting ratio. What would be the effect on the following actions? Okay. Increase in the selling price of Z. Okay. Before simply applying these changes and checking what is the impact on throughput accounting ratio, let's first read the data, what it says. A manufacturing company decides which of the 3 mutually exclusive products. Students, we have already discussed this concept. Mutually exclusive means rule of OR. For example, if 2 products are mutually exclusive, A and B, so it means a rule of OR. either you will be working on A or you will be working on B. Okay. All are mutually exclusive. So mutually exclusive means rule of or. So all the products are mutually exclusive. And it is factory on the basis of maximizing the company's throughput accounting ratio. You need to decide. Either you're going to work on X, Y, or Z because all are mutually exclusive. Current data for 3 products is shown in the following table. Selling price per unit is 60, 40, and 20. Direct material cost per unit 40, 10, 16. Machine hours per unit 10, 20, and 2.5. We have 10, 20, and 2.5. Okay. Total factory cost excluding direct material is 1,50,000. Great. The company cannot make enough of any of the products to satisfy external demand. So demand is a lot. Entirely as machine hours are restricted. So the bottleneck is the machine hours. Before checking the decisions, if we go for option 1, what will be the impact on throughput accounting ratio? Let us first calculate. Let us first calculate at least a return per factory hour of each product. And it says a manufacturing company decides which of the 3 mutually exclusive products to make in its factory. So out of these 3, which one we should produce? Because all are mutually exclusive. Okay. Another point is, if nothing is mentioned, it means the factory cost will be same for all the 3 products. If the factory cost is same for all the 3 products, then ranking will be just done on the basis of a return per factory hour. So let's first check which one is more beneficial without implementing any decisions. Question 56. We have 3 products, X, Y, and Z. Selling price per unit 60, 40, 20. Direct material cost per unit 40, 10, 16. Here comes throughput per unit. Let's see. What is the throughput per unit? 20, 30, and 4. Now, machine hour per unit is the bottleneck. Bottleneck means limiting factor. Machine hours per unit. Ten, 20, and 2.5. This will give us a return per factory hour. A return per factory hour. 2, 1.5, and 1.6. Okay. So right now it can be seen that product X is more beneficial. Why product X is more beneficial? Because right now product X is giving us highest return per factory hour. Okay. Now come here. What would be the effect on the following actions of the company throughput accounting ratio? Let's see. Would improve company's existing TPI and would not improve. Number 1. increase the selling price of Z by 10%. If we increase the selling price of Z by 10%, let's see. Option 1. Now try to understand if we are increasing selling price of Z by 10%. Z is having a selling price of 20. 20 multiplied by 1.1 will give us 22. Obviously, the direct material cost will remain same, which is 16. This will give us throughput 6. Bottleneck time for Z is 2.5 hours. So 6 divided by 2.5. Students, I'm getting 2.4. So basically, due to option 1, return per factory hour will become 2.4. Now try to understand. X is 2, Y is 1.5, and let's say Z changes to 2.4. If this is the case, then Z will be more beneficial now as compared to X. If I implement option 1, so this will definitely improve the throughput accounting ratio of Z. And obviously now Z would be better than X. Due to option 1, throughput accounting ratio will improve. Throughput accounting ratio of Z will improve. And now Z is better than X. So would improve existing TPR? Yes. Option 2, increase the selling price of Y by 10%. If we increase the selling price of Y by 10%, let's see what happens. Option 2, increasing the selling price of Y by 10%. What is the selling price of Y? It is 40. So 40 multiplied by 1.1, we'll get 44. Direct material cost, we know that it is 10. So throughput per unit is going to be 34. And machine hour, they are 20. Machine hour bottleneck is 20. So 34 divided by 20, I'm getting 1.7. If this is the case, then obviously there's no benefit at all. Why? If Y is going to have a return per factory hour instead of 1.5, 1.7, still I'll go with X because X is having a higher return per factory hour. So even we implement option 2, this is not going to improve throughput accounting ratio. Why? It is not going to improve throughput accounting ratio. Please try to understand. X will have return per factory hour 2, Y will have 1.7, and Z will have, let's say, 1.6. So obviously, still X is better than Y, and initially X was better than Y. So even we implement, and let me tell you, all the products are mutually exclusive. Okay. So right now, all options we'll be looking in isolation. Now, for example, forget option number 1 now. Now let's say this option number 2 is just in front of you. So even you implement option number 2, your ranking will remain same. That is, X will remain the best option. And let me repeat, when you are applying option 2, you will not be thinking for option 1. So simply option 2 will not change throughput accounting ratio. So increase in the selling price of product Y will not improve throughput accounting ratio. Option 3, reduce the material cost of product Z by 5%. Now let's see what happens. If we reduce the cost, option 3. Selling price of Z, we know that it is 20. I told you, students, when you are applying one option, you will forget other options. So selling price of Z is 20. Direct material cost. What are they saying? Direct material cost reduces by 5%. Okay. Direct material cost is 16, reduces by 5% means I'll take 95% of 16. 15.2. That will give me the throughput of 4.8. And bottleneck is 2.5 hours. I'm getting 1.92. A return per factory hour, I'm getting 1.92. Please, students, try to understand. When we are applying option 3, you will not be thinking for option 1 and 2. So each option will be compared with the existing scenario. And existing scenario says X is better than Y and Z. Now listen, even I apply option 3, Z will not be having a return per factory hour more than X. So still X will be better. So in option 3, your throughput accounting ratio will not improve. Option 4, reduce the material costs of product Y. Option 4. What is the selling price of Y? Let's see. 40 and 10. Okay. 40. Direct material cost is 10. If I take 95% of this, so it is going to be 9.5. So 40 minus 9.5 gives me throughput of 30.5. Bottleneck is 20 hours. I'm getting 1.525. This is return per factory hour. When I'm going to compare option 4 with the existing scenario, so obviously product X is better because it is giving me the return per factory hour too. So students, repeat, each option will be compared with the existing scenario. An existing scenario says X is better than Y and Z because X is giving us a return per factory hour $2. Before applying any option, X is better than other two products. Number 1. Number 2, each option you will see in isolation. So when you are applying option 4, you will not be considering other options. So under option 4, the ranking will not change. Still, we will go with product X because all are mutually exclusive. So I'm going to actually produce the product which gives me the more benefit. So it means throughput accounting ratio in option 4 will not improve. I would say a good question. Now let's go ahead. What is the cloud's throughput per hour of the bottleneck resources to the 2 decimal places? What is the cloud throughput per hour of the bottleneck? Simply return per factory hour we need to calculate. Okay. Sky Limited operates in an environment where products go through 2 processes and detail of their capacity are below. Process P, there are 8 machines operating at 90% capacity. each machine produces 6 units per hour. So process P. One hour. Let's see how many units they will be producing. There are 8 machines working at 90% capacity. Per hour, they are manufacturing 6 units. 8 multiplied by 0.9 into 6, I'm getting 43.2 units. It means question says they are manufacturing a product which passes through 2 processes. It means in an 1 hour, process P is good enough to support the manufacturing of production of 43.2 units. Okay. Process Q, there are 6 machines operating at 85% capacity. Each machine produces 9 units per hour. So it means process Q. Let's see. In 1 hour, how much they can produce? There are 6 machines working at 85% capacity, and each machine can produce 9 units per hour. 6 into 0.85 multiplied by 9, I'm getting 45.9 per hour. Obviously, the process which makes less units per hour, that is your bottleneck. The process which manufactures less number of units per hour, that is your bottleneck. So the bottleneck is process P. Obviously, for calculating a return per factory hour, we'll calculate throughput per unit, and then it will be divided by bottleneck time, bottleneck resources, and bottleneck is process P. It's not process Q. Sky Limited produces the cloud, which is not a popular product. The marketing manager has therefore decided to apply a pricing discount, 15% on the selling price of 20 per unit. That's question number 57. Selling price. That's going to be 17. So selling price per unit is going to be 17. We will deduct direct material cost per unit. That will give us throughput per unit. And then it will be divided by the bottleneck time, which is required per unit. So bottleneck resources. Then you will get logically throughput per hour, or you can say return per factory hour. Direct material cost is 5. Throughput is 12. Process P is the bottleneck. And direct labor cost per unit is twice of that material cost of the cloud. It currently takes 0.2 hours and 0.3 hours to make a unit of the cloud on the machine in process P and Q. So process P takes 0.2 hours, and we know that bottleneck is process P. So 12 divided by 0.2 will give us 60. A return per factory hour, and they are saying 2 decimal places, so you can write like this, 60.00. Okay, let's go ahead. If the company is not able to increase the availability of machine C's operational hours, what is the production ranking of product Y? Okay, let's read the scenario again. It says if the company is not able to increase the availability of machine Z's operational hours, it means machine Z is the bottleneck. So what is the ranking of product Y? Let's see. A manufacturing company uses machine C, which is operational for 5 hours a day to manufacture 4 products, W, X, Y, and Z. Factory cost is 1,50,000 per day. The company uses throughput accounting and its objective is to maximize the profit. Information relating to these production is as follows. Production rate per machine hour. So W, in 1 hour of machine, we can produce 200 units of W, 500 units of X, 400 Y, and 350 Z. Selling price per unit, direct material cost per unit. Actually, from the selling price per unit, when I'm going to deduct direct material cost per unit, I'll get the throughput per unit. Okay. In 1 hour, how many units we can produce? We know that. So very easily, we can go for the ranking. There's no need to go for the ranking on the basis of throughput accounting ratio. Why? Basically, when you have limited information, so simply, we do assume that all the products are having same factory cost per machine hour. If the factory cost per machine hour is same for all the products, then there is no point to make the ranking on the basis of throughput accounting ratio. In that case, you can simply make your decision on the basis of total throughput. So simply 350 minus 120, that will give us throughput. Multiply by 200 units. So let's see what is the total throughput. 350 minus 120, I'm getting a throughput per unit 230. In 1 hour, W units can be produced 200. So I'm getting total throughput in 1 hour 46,000. 190 minus 95, how many units we can manufacture in 1 hour? That is 500. Let's see. 190 minus 95, 190 minus 95, multiply by 500. I'm getting 47,500. 270 minus 160 into 400 units. So 270 minus 160 into 400 units. I'm getting 44,000. 215 minus 75 into 350. 215 minus 75 into 350. So we have, okay, 49,000. Now ranking. In 1 hour, Z is the one which is giving us the highest throughput. So Z is going to be first. Then we have X, 47,500 is going to be second. W is going to be third. And Y is going to be fourth. Okay, now. Which of the following will improve throughput? A manufacturing company uses 3 processes to make its 2 products, X and Y. The time available on the 3 processes is reduced because of the need for preventative maintenance and rest breaks. A manufacturing company uses 3 processes to make its 2 products, X and Y. Okay. The time available on the 3 processes is reduced. We have less time because of the preventative maintenance we are doing and due to rest breaks. So time is limited. The table below details the processes time per product and daily time available. Hours available per day is 22. Hours required to produce X, Y. Daily demand, X is X and Y. X is having 10 units and Y is having 16 units. Let's see. See, number one, we need to identify which process, because they're saying a manufacturing company uses 3 processes to make 2 products. So each product X and Y, they go through 3 processes. So first we need to identify which process is the bottleneck. Because by working on that bottleneck resources, you can improve your throughput accounting ratio. First, let's find out which process out of these 3 is your bottleneck. Very simple. Process 1, available hours, we have 22. Let's say required hours. Available hours daily and required hours daily. Let's see. The demand for X is 10 units. 1 unit of X takes 1 hour. So multiply by 1. Demand for product Y is 16 units and 1 unit of Y takes 0.75 hours of 0.75 hours of process 1. So 16 multiplied by 0.75 plus 10. Process 1 is not bottleneck. Why? Because hours available we have 22 and required they are also 22. Process 2 available we have 22. 10 units into 0.75. 16 into 1. I'm getting 23.5. Available is 22. Required is 23.5. So definitely process 2 is the bottleneck. Obviously, more than one bottleneck cannot come. That is not examinable. Let me repeat. Right now, and we know that TOC, theory of constraint. At one time, there will be one limiting factor and you will be working on that. So process 2 is the limiting factor. If you want, but in exam, if you just, let's say you're sitting in exam and you have decided process 2 is the bottleneck and you have decided perfectly, no need to check process C, but right now, let's check also. Available hours are 18. 10, how much time it takes? 1. Available hours are 0.5. So simply it is taking 18 hours. Process Z, available hours are 18 and required is 18. So obviously process B, process 2 is the bottleneck. Now, increasing the efficiency of maintenance routine of process 2. Yes. If you increase the efficiency of the maintenance routine for process 2, your throughput accounting ratio will improve. Increasing demand for both the products, what benefit you are going to get? You will not be, actually it is not going to, increasing the demand will not increase the throughput accounting ratio. Reducing the time taken rest breaks on process Z. Z is process 3. Process 3 is not your bottleneck. So what benefit will you get if you make it more efficient? Reducing time of product X required for, again, if you make process 1 and 3 more efficient, you will not be getting a benefit because they are already non-bottleneck resources. So increasing the efficiency of non-bottleneck resources will not provide any benefit, will not increase your throughput accounting ratio. Because throughput accounting ratio is always calculated on the basis of bottleneck. So bottleneck is process 2. Bottleneck is not process 1 and 3. Again, now let's see. Which of the following below statement is not true of throughput accounting ratio? Throughput accounting considers that the only variable cost in the short run are material component, that's true. Actually, we need to find out which one is not true. So one is true. Throughput accounting considers that time at a bottleneck resources has value, not else. Yes, everything is on bottleneck. Throughput accounting views stock building as a non-value added activity and therefore discourages. True. Throughput accounting was designed as a decision-making tool. No. Actually, it was designed for the performance measurement, not for the decision-making tool for a situation where there's a bottleneck in the production process. So it is actually made for the performance measurement, not for the decision-making. So basically, it is not for the decision-making. Logically, it is for the performance measurement, which product is performing better. Which of the following is a definition of throughput accounting ratio? How do we calculate throughput accounting ratio? Simply return per factory hour divided by cost per factory hour. Throughput accounting contribution, no. Consider cost per factory hour and return per factory hour. So it is actually return per factory hour and cost per factory hour. 61. So simply, how do we calculate throughput accounting ratio? Return per factory hour. Return per factory hour and divide by cost per factory hour. So that is all about, I would say, section A of throughput accounting. In the next class, we are going to discuss section B. So thank you very much.